The business operating culture in Kenya is generally based on the concept of owning equipment. This trend, however, is slowly changing with more institutions opting for leasing.
Historically, what we've done is we've financed the acquisition of assets such as vehicles, equipment via hire purchase or asset finance, and that typically required that we find the deposit, and often that was a substantial deposit. We would then also have to cover the cost of insurance, whereas with leasing, that is a far simpler and convenient process because there's a very nominal deposit or no deposit at all, and the facility includes insurance and all the other installation costs.
What you're actually able to do is to actually, instead of spending all your money buying fixed assets, you can actually lease assets. You'll be able to lease a lot more assets with the same amount of money. Secondly, you'll be able to manage your cash flow. The lump sum requirement for assets or capital items when you're starting up or when you run a business, you don't really need to incur that. You can actually lease and then pay monthly or quarterly installments for that piece of equipment. You'd also be able to assign very clearly your costs. So certain items will be able to justify their existence, for lack of a better word, because then you would know that it is paying for itself. Unlike a capital item where you spend all your money on it and you're unable to assign direct costs to that asset.
From supermarket shelving, heavy construction, ICT, and even kitchen equipment, to name a few, institutions like Riara University is one of the new universities in Nairobi, which has embraced leasing, does not only benefit from tax subsidies, but also saves on downtime in case of equipment breakdown.
Within the overall package of the operating lease, it has an SLA with the third-party provider that in the unlikely event and the specific asset was to either not function, there is an agreement that they would provide a replacement, okay, in the interim when they are either repairing the asset or even in an extreme need, it needed to be replaced. So that again is a very, very, very big plus because when you compare it to an asset finance, that asset belongs to the client, and therefore if it does break or it does not function, then we have to meet that cost directly by either finding a replacement or meeting or getting it repaired.
Okay, from a tax perspective in particular, because the asset is actually leased, you are able to expense the entire rental, as it were, from your profit and loss account. And that way you tend to find you will be able to really reduce your taxable income. Some people may not know that altogether, and if you're not profitable, you can't say that you will not use it. For some, we always say it's a way of managing your value-added tax. Lease rental is actually a VATable service, and you're then going to be able to offset your lease rental against your other VATable income.
During the recent tabling of Kenya's 2013-2014 budgets, the National Treasury allocated 3 billion shillings towards the purchase of motor vehicles, highlighting the potential impact that leasing could have on both private and public institutions.
What we'll actually do is put in more assets for the use of the government. What you'll actually be able to do, or they will be able to do, is provide better service delivery to Kenyans. So for what they'd have gotten, for example, for that amount of money, they'd be able to actually get 3 times the number of assets and therefore be able to deploy these assets faster for use by Kenyans.
It's all about customer service. It's about saving costs for the customer. It's service delivery. If you look at, instead of buying equipment, if you lease equipment, you can get 3-4 times the same equipment for the same cost of money. We include maintenance. We include insurance. It becomes a one-stop shop. It's a one-stop solution,
But there are, however, challenges that come with demystifying the concept of leasing.
Challenges for the leasing market is the perception that you have to own your assets. People feel that they're enriched by owning it. It's not adding value. You shouldn't be using shareholder funds to employ it on non-core assets for your business. It should be done, focus on your business and outsource the functions that's not critical to adding shareholder value as well.
The first of these, I would say, is the culture of ownership. A lot of people cannot separate owning an asset and using it. There is more benefit in using it than there is in owning it. There is a cost of ownership, and a lot of people do not factor that in when they're buying assets. There's a cost to that, and most times, there is an administration time involved in that asset. You also don't have the benefit of using that asset when it is down. With a leasing option, you're also able to get sort of replacement assets, so you have less downtime than you would by owning an asset. Also, a lot of times what we have is a misunderstanding around the product itself. A lot of people think there's a scam behind all of that, and we are saying we want to try and demystify that and actually show there are some tax and accounting benefits at the same time.
With the government embracing equipment leasing, it appears that there is progress from a financial resources management perspective in the public sector. Private institutions, on the other hand, can perhaps take a leaf from this asset utilization avenue, leaving them to focus on their core businesses.
When you are leasing, the assets don't sit on your balance sheet. So therefore, in terms of the gearing on your balance sheet actually looks much healthier, much stronger, particularly when you're talking to your bank, because these assets are sitting off, they're on a lease, and you're paying a monthly installment. So therefore, your balance sheet actually looks much stronger and much healthier.